Investment returns follow economic growth, right? So the essence of the perpetual growth machine is that problems usually bring solutions. And solutions require change, and change is what brings opportunities for growth and returns for investors. Growth makes everything look cheap. It's finding that growth and appreciating it ex ante that is so devilishly. Tariffs are a form of regressive tax, which means that they affect lower cohorts of income distribution disproportionately stronger. The biggest opportunity on a go-forward basis lie outside of the U.S., whether it's Japan, Korea, Europe, some of the smaller DM economies, select emerging markets. This U.S. retrenchment from the global world order and the U.S., China, what feels like an increasingly adversarial relationship, has the potential to undermine the longest period of peace and economic prosperity in modern history.
Hi, Olga. Welcome to Excess Returns.
Oh, it's a pleasure to be here. I'm excited to talk to you guys.
Thank you very much for joining us. At William Blair, you serve as the firm's global strategist, where you focus on what's happening around the world, both in economies and different markets. And so you're thinking about looking at trying to understand the drivers of growth, big picture trends, and potential turning points, and how all of these things and pieces feed into the investment strategies, allocations, and the portfolios that you're building at William Blair, which is, to me, seems like a really cool and probably fun, dynamic job. And you've been doing this in this role for almost a decade. So I know you're going to have some really great things to share with us and our audience. We want to talk to you today about the state of the global economy, where there may be some risks that investors might not be paying attention to, but also opportunities. And then think about how we kind of might think about this in terms of positioning one's portfolio or portfolios going forward. Our audience can learn more about the firm William Blair at williamblair.com. They have a lot of great research they're putting out. They have some of their own podcasts they're putting out. And there's just lots of good content for both professionals, obviously, and retail investors. So with that, I wanted to start with you, which we were just talking before we started here, about this concept framework of what you call the perpetual growth machine. So I thought maybe to start, we could walk through like what this actually is. And then, as a second point, how it helps you shape your investment philosophy and how you look at markets.
Thanks, Justin. Look, let's start with probably the most obvious observation, which is that investment returns follow economic growth, right? So the essence of the perpetual growth machine is that problems usually bring solutions. And solutions require change, and change is what brings opportunities for growth and returns for investors. So the concept of the perpetual growth machine is really our description of how economic growth happens. It helps us to illuminate under what conditions economic growth specifically accelerates and what hinders it. So at the core of it is an anthropological observation that people's need for improvement is constant and ubiquitous. We all want better homes and better harvests and easier ways to make a living. We invent and innovate, we imagine, we put our scarce resources to solve for the current needs. This process releases more resources and in turn produces new and different needs. And so it's a perpetual cycle. Now, before it sounds too good to be true, our individual and collective appetite for improvement is constantly bumping up against other people's vested interest in the status quo, or misaligned incentives, or just plain unwillingness to change. And the sum of this tug of war, if you will, is usually measured as economic growth. So if needs catalyze invention and innovation, we as investors need to ask what needs and challenges a particular business or industry are facing. Are they innovating from within or risk being disrupted from without? Who is working on solving a similar problem from a different angle? Perpetual Growth Machine points to the need as a quality growth investor, which is what we are here at William Blair, to cast a pretty wide net on investment opportunities. Another interesting insight, if I may, is that monopolies are quite detrimental to future growth, even though investors love them for their strong and stable returns. So should we view a government's actions to curb monopoly power as anti-capitalist or pro-growth? So these are the sorts of things, if you will, that the perpetual growth machine as a framework allows us to ask and increasingly answer as investors.
It would seem like our capital markets and democracy and the degree of freedom we have in the United States and in other countries like the United States would sort of be more supportive or foster, companies that benefit from this idea, right? Versus, to your point about monopolies and the hard government hand coming in, it seems like those countries obviously wouldn't be the ones that would receive as much benefit. Although, as I think as humans, we all want to try to be improving, but depending on where you are around the world, I'm sure it varies a lot.
Indeed. And that's another insight from the PGM, if you will. It's not so much comparing which country is better. It's whether current policies answer the needs of the majority, allow the majority to do what they want to do, to innovate, to improve, to continue to grow, rather than select, small minority vested interests. And it's policy by policy, jurisdiction by jurisdiction. Different policies will be appropriate to different places at different points in their economic development. Just like some of the policies that we have here were probably good at one point and answered some of the needs, but over time become fossilized and no longer serve the needs of the majority. And so we have a bottleneck. It's a really, really dynamic process.
I want to ask you about tech here in a minute in AI, but I just thought of something. I'm wondering, I'm thinking of the housing market in the US right now. A few decades ago, the American dream was to own a home. Many Americans could eventually, buy a house and have a family. And, now it's like home ownership is almost out of reach for so many people because of, the combination of prices, where interest rates are. Maybe you could make the argument wages haven't kept up with. But I'm wondering, is that when we think about possible risks, and maybe I'm jumping ahead a little bit, but, how does that play into this perpetual growth machine in the US in the sense that housing is such an important piece of the economy? Do you have any thoughts on that?
Absolutely. As with any industry and sector, you'd want to see what are the impediments to more affordable, broader based housing. Is it, to your point, people's incomes? Why are, today in the US, as you know, is pretty bifurcated. So half the US population is enjoying real income that is somewhat between 72 and 75% of what it was in the late 60s. So, and this isn't just a handful of people or the bottom 10% of the income distribution. That's half. So that's a real problem. We need to ask, why would that be? Why are people persistently underpaid? Are we underskilled? Are we underproductive? Are we under-resourced? If so, where, by whom, and how, right? And then you pivot to housing and say, okay, why is not more being built? How can we ensure that more is being built? Then you look at the affordability and the mortgage rates and you say, okay, why are mortgage rates at current levels? Can they be lower or higher? Is that simply a function of the Fed monetary policy, or is there something more at play? So the PGM points to quite a lot of the need for a lot of specificity as relates each industry, each company, each product.
How do you think about a new technology like artificial intelligence in this context? On the one hand, you hear about, and I'm sure all of us are, using things like ChatGPT or Claude in our day-to-day work processes and things that we're doing, and companies are trying to use it to become more efficient. But when a new big technology like this comes on the scene, how do you think about that in the context of this perpetual growth machine? And, you go back to the internet era, there was obviously all this capital that was chasing all these internet companies. You sort of had this wipeout of many of them. The ones that survived many of them went on to be some of the most valuable companies in the world. The ones that did very, very well. Obviously, it's a small sample, but still, you get the point. So how do you think about AI in the context of the PGM framework?
Sure. So AI is a brilliant current example of what we call a general purpose technology breakthrough, right? Which releases huge amount of new resources. So we can debate the timeline, but eventually I think everybody broadly agrees that AI models will greatly reduce the time spent by much of you and I's and white collar professional services workers in general on collecting information. So a comparatively lower value add activity, right? So how much might that be worth? Let's put it into numbers. Very rough math here. So the global economy is estimated at roughly north of $110 trillion. Okay. Labor's share of the economic output is declining all the time. It's probably around 50% or so now globally. Obviously, this average skews lots of deviations, but let's assume it's close to 50. Let's be super conservative and say it's 40%. So now, if we assume that AI can save just 1% of that bill, if you will, that's annual savings of $400 billion. And it's not hard to imagine that savings might be closer to 5%, in which case we're talking about $2 trillion worth of savings annually. A classic example, right, according to PGM, of a new tool or solution releasing a lot more resources than were used to create it. And that's just the start, right? Like, eventually AI models and advanced compute will be able to model human organs in real time. I mean, we will be able to see and assess hundreds of billions of cellular and intracellular interactions simultaneously to eradicate and prevent countless acute and chronic diseases, and do so, without today's healthcare costs, which in the US alone are clocking in at over 10% of GDP annually. So, the breakthroughs here are, potentially enormous. And you can imagine the kinds of, corporates that will be benefiting here, and the profit pools are enormous. And of course, just like as part of PGM, solving a need creates a new need and a next set of problems, right? So AI breakthroughs will produce the next set of problems. Are people going to lose their jobs? What if the life expectancy goes up by 10 years? What if it goes up by 20? I mean, these and countless others will necessitate their own solutions, maybe like a 3-day work week, for example, and so on. So it's a perpetual growth machine.
There you go, Jack. Less podcasts for us to do during the week. Well, let me. I want to ask you. We talk to a lot of people at many size firms, and William Blair has I think a few hundred employees and full of knowledge workers, investment strategists, portfolio managers, and all the infrastructure to support delivering those strategies and investment solutions to your clients. But how, and hopefully I'm not asking you to divulge any trade secrets here or anything like this, but how is a firm like William Blair, with the size you are, how are you guys incorporating AI at a firm-wide level? Or is it maybe more micro and individual now? Or is there an emphasis on sort of bringing this more broad based to the firm? Because we don't get, you're a little bit unique in the sense that you're at a little bit larger firm than most of our guests. So I'm just curious as to how AI is being utilized at the firm-wide level.
Sure. So that's a great question. And I think your question pointed to the specificity, which again, not to toot my own horn, but is part and parcel of the perpetual growth machine. And the specificity is really related to a particular job function. So I'm firmly on the investment side, so I'll just speak to that, right? The amount of time you would spend researching something, just go back to the economics function. Back in the day, 60s or 70s or, something around there. In order to find some data, you literally had to go to the library, get some microfiche, and start looking at this, at the various data series. Then came Excel. You could download things out. There was more and more data, but the quality was dubious. Well, today, everything is available literally at your fingertips. The amount of information, the amount of data, both structured and unstructured, is exploded enormously, just even in the last 5 years. A concrete example from the economics profession. We used to not be able to track services spending in real time, which is why services consumption data were only available on a quarterly basis, and those were rough estimates. Well, today with, digital payments and credit card proliferation, which admittedly COVID hastened, everybody pays digitally or nearly digitally, such that broad spending patterns are available daily and weekly and monthly for for most of us that are as far away as possible. So that is changing what's possible in terms of analysis. It's changing how fast investment professionals can assess the changes in relative companies' profit opportunities. It's changing how we evaluate what goes in and out of portfolios, right? Not the investment process itself, but the speed with which things become known, the information barriers are coming down, and the speed with which we can react as outside investors is changing all the time.
Getting back to the perpetual growth machine, what sectors or themes or developments that you're seeing that are getting you sort of most excited when you look at, I guess, opportunities through this sort of framework?
Sure, there are always loads, but here's one. This is kind of top of mind, so I'll start with this one. So today, the US is no longer willing to provide European defense. So Europe is responding by building its own. And specifically, fiscal spending is increasing to build ready-to-deploy capabilities to ensure things like interoperability and stay at the cutting edge of AI, robotics, microelectronics, all other technological frontiers that are redefining battlefields. I can't even pronounce half of them. So we're seeing a mix of emerging national champions and small cap defense innovators all across Europe, just in the last handful of years, as really fruitful opportunities over the next several years. So the investment opportunity here, just to be clear, is NATO European defense. It transcends the Russia-Ukraine ceasefire, which hopefully will be achieved soon. And incidentally, my colleague Michael Patchen recently penned an excellent and detailed blog on this theme. So for anybody who's interested in delving deeper into this topic and the investment opportunities that it's throwing out, it's well worth a read.
Just one more of this before we go into the economy. I just want to ask you about monopolies. You mentioned monopolies before, and I've been thinking about monopolies a lot recently because I would assume like monopolies are not the greatest thing for growth. But then I look at maybe some of the companies, the Googles of the world and the Amazons of the world, and like we've all benefited a lot from that. And I wonder, like, with AI and with technology, is this changing sort of the relationship between monopolies and growth? I mean, are monopolies, they're bad for society, I think, but in some ways, are they good for growth, like in this world dominated by technology and AI?
Well, so that's a great question. Whether they're good for growth, the Perpetual Growth Machine framework would suggest not. And one of the reasons that I remain of that view is that, look, monopolies fundamentally have no reason to innovate. Okay, if you're already a monopoly, why do you care if your clients are happy or not happy? Why do you care if your suppliers are concerned and you have no competitors? So, and if you don't invest and innovate over time, you fossilize, growth slows. If you prevent others from coming in and incurring on your space and curbing your monopoly power, that also, disincentivizes and inhibits future growth. Now, paradoxically, we as investors love monopolies, right? Because of their, strong and predictable earnings stream. But sometimes, and especially in places like China, where you see the regulators being relatively more aggressive than we are here about monopolies, we kind of have to ask again to the question that I posed at the beginning. Are we being, or is the government being anti-capitalist, or is it being pro-growth? In terms of tech and the monopolies, and one of the reasons what we're seeing in AI build out and the LLM development is exactly the opposite of monopolies, right? There's a massive competition going on to develop the LLM model, if you will. And so in that sense, how you define monopoly again needs to be specific to what you're competing in, the specific area or domain of competition.
It's interesting too, how sometimes these things that we think are monopolies end up working themselves out. Like if you asked me 5 years ago about Google search as a monopoly, I'd be like, there's no way anybody's going to disrupt Google search. And now if you ask me today, Google search is in a world of trouble. So it's just interesting. Sometimes the market figures this out on its own.
For sure. Well, that's why working in the markets is so incredibly interesting.
So I want to shift to the economy. You've talked about this idea, and this is something I think about a lot because we've had these tariffs early in the year. We're kind of at a point where we don't really know. I think the market's kind of assuming there's not much of an impact here, but we don't really know what the impact is because it takes time. And you've talked about this idea of an economic air pocket that might occur sometime in 2025. So I wonder, could you talk about that a little bit more and how you're thinking about that?
Sure. So we've actually already seen many consumer categories underperform the broader U.S. market this year. So staples, household and personal products, food and beverages, there's a whole host of others. And I think looking forward, the consumer was pretty weak in the second quarter of this year. Consumer spending, grew by basically less than 1% annualized. So looking forward, I think the housing market is likely to see more support via lower mortgage rates. That's an obvious area of interest for the current administration. And so companies servicing that could experience an inflection in earnings growth. So again, regional banks, which originate local mortgages, DIY stores, home builders, folks of that sort. So that's how I think the air pocket will resolve itself as we move into 2026. And that's one of the reasons I called it an air pocket and not something more sinister.
How do you think about inflation? There seem to be two camps in terms of our guests we have. Some that think inflation has not been put to bed at all and that it's slowly creeping up here and that it's going to come back and be a major problem. And then other people think, and partially this is probably because of AI, but partially because of other factors, that inflation's kind of not a factor right now, not a big issue. Like, how are you thinking about that?
Inflation is oscillating. Let's stick with facts, right? So inflation is oscillating between 2.5% and 3.5%, right? For now. So this is nothing even close to what we experienced post-COVID when we saw, high single digit approaching double digit rates of inflation. But under the hood, we're seeing goods prices outside of energy contributing positively to overall inflation, which is a distinct departure from where we have been for 2 decades prior to COVID, and services inflation materially higher than in the last decade. So right now, it looks as though the growth inflation trade-off in the economy is worsening, meaning that for a given rate of growth, we're going to have more inflation. This is due to what I would categorize as suboptimal policy mix, but this has nothing to do with what the Fed is doing. So there's not a whole lot that the Fed can do here.
Do you expect inflation to be pretty volatile going forward?
Most likely. Look, I think inflation is likely to oscillate in it again, 2.5 to let's say 4% range, which I know is quite wide for comfort, but it is likely to be more volatile for several reasons. Look, we're introducing a lot of significant policy changes, which will reverberate through the economy at different speeds. And, one is tariffs, right? So companies will choose to raise prices at different times in different speeds, depending on their consumer segment, their product segment, et cetera. Immigration raids also don't happen all at once, and so will affect different consumption pockets and different industries at different times. So yes, I think volatility will be more significant than it has been in the prior decades, but certainly a lot lower than we experienced during COVID.
We usually don't do too much Fed watching on this program, but we are recording both the day before or the day of actually the Fed meeting, so this will come out right after it. Like, how do you think about the position the Fed's in right now? It seems like they're in a pretty challenging position. Inflation hasn't been completely put to bed, but, we are seeing some signs in the labor market of weakening. Do you have any thoughts on the position that they're in right now?
Well, so that goes back to what we just talked about, right? Which is that the inflation growth trade-off in the U.S. economy seems to have worsened. And the policies that we currently, are affecting are worsening that trade-off, every day. And so the Fed is going to have to, figure out how to weigh its dual mandate a little bit differently. Is it going to be more focused on inflation, or is it going to be more focused on the employment growth, which has been pretty anemic this year, and is likely to probably worsen in the absence of more stimulative policies. So my hunch is that the Fed will err on the side of the latter, and will seek to support the labor markets. The extent to which that will spill into significantly more inflation remains to be seen, but we are in a higher inflation and more volatile environment moving forward, almost irrespective of what the Fed does.
Yeah, and it's challenging. We're obviously talking about this a lot with the Fed independence issue right now is, obviously on one hand, there's what the Fed maybe should be doing or thinking about, and then we've got a lot of pressure on the Fed. And the question is, how are they going to respond to that?
Sure. It's a tough situation to be in. But look, I mean, they do have a dual mandate. And one of the things I think it's important to keep in mind is that the Fed is very powerful in a very narrow jurisdiction. So specifically, if the economy is cooling or overheating, they can act to suppress, or amplify those shocks. But they can't do anything about, regulatory burdens on businesses. They can't do anything about competition law. They can't do anything about product specifications. They can't, improve zoning rules. They can't change the labor market. So there's a whole host of policies and outcomes, if you will, that they have absolutely nothing to do with. And yet I feel like increasingly they get blamed for everything. So
It's a tough job, but we've had a bunch of guests point that out. But the Fed, we all like to criticize the Fed, but they do not have the easiest job in the world.
For sure.
I want to switch and talk about tariffs because I know you've studied tariffs a lot, and it's something I'm thinking about, as I mentioned earlier. We've had these tariffs. I mean, obviously, they've fluctuated a lot. They've kind of settled down a little bit now. But I'm trying to think about like what the implications of it are, because we've had the tariffs. We probably haven't had enough time to understand the true economic implications. Like, what do you think when you're thinking about what those implications might be? How are you thinking that through?
Sure. So look, tariffs actually have a pretty storied history, in the world economy. So tariffs were really the only or the dominant form of tax up until the early 1930s, I would say. So we have collectively and individual countries a lot of experience with tariffs, and of course tariffs have been used subsequent to that episode as well. And look, there are a couple of things to point out. Number one, tariffs are a form of regressive tax, which means that they affect lower cohorts of income distribution disproportionately stronger. So you need to think about whether that is a policy you want or not, and how that affects your spending patterns. Tariffs are also, beyond sort of their immediate impact on goods, prices are a tax on your domestic consumer. So ultimately, whether it's through direct price increases or smaller portions or lower companies or lower quality, goods, companies will find a way to pass on, tariff related costs, right? So for a given level of income, we're going to spend less. And then beyond that, we may or may not have fewer product choices because some companies will limit the options sold in the tariffed market. So in the US in this case. And finally, and this is the point I keep coming back to within the perpetual growth machine, which is that domestic producers will be more insulated and therefore have less need to innovate. So like, why bother when your margins are already protected and your competition is lessened? Tariffs can be detrimental. What their full impact will be is a function of how long they will last. Some of these things that I've highlighted take a long time to surface, right? It's certainly not going to be months. It'll be quarters and years before we see it. But in terms of investing, I mean, tariffs are a change, and change produces new winners and losers all the time. And the market is great at sniffing out, where the profit pools are changing and who is becoming a de facto domestic monopoly and where we should be focused as investors.
And I believe you've written about this washing machine example that we've had as a more recent example. And I think in that case, we did find that most of that was borne by the consumer, correct?
Correct. It's not, washing machine is the most recent example, 2018, 2019, where we saw not only the demand for washing machines, but paradoxically the demand for dryers also kind of trended down a little bit lower. But we have history of tariffs in the steel sector, for example. We've had tariffs there since the 70s, and yet U.S. domestically produced steel is still, steel prices are still some 40% higher than anything you can get from, Germany or Japan, which are also high cost jurisdictions. So that points a little bit to that, protection as a form of insulating companies from competition, and so points to less need to innovate.
Do we have any evidence? It might be too soon. Do we have any evidence yet in terms of these new tariffs and where they're going? I thought I read something recently that the U.S. companies maybe are eating it a little bit now, but people expect it. Eventually it'll probably work its way down to the consumer. Is there any evidence yet as to where this is going?
So we're already seeing the non-energy goods prices showing up positively in inflation numbers. And that's a material departure from where we've been for 2 decades prior to COVID, right? Because goods prices have been firmly disinflationary for, several decades. This is a change. So it's already showing up in U.S. inflation numbers, actually. And I would argue this is even before most companies have passed on the price increases, and certainly not fully.
I want to shift to the idea of U.S. exceptionalism, because that's something that's been on a lot of people's minds recently, this idea that the U.S. has been the growth machine, the dominant tech companies are in the U.S., and this idea that might be changing in the future. So how do you view that idea?
I think, what's driving the sort of the change or the narrowing of the U.S. economic exceptionalism, is really this idea of it's a response to, America First policies, right? So in Europe and in Japan, this will take the form of much more spending on defense, on energy, on infrastructure. We're starting to see early signs that some of the recommendations of the Draghi report in EU, for example, on the internal market are starting to be taken seriously. In China, the government understands the imperative to be self-sufficient in most advanced technologies across virtually any industry you can think of. And this is driving tremendous investment into everything from semiconductors to new molecules for drug compounds, right? So all of these investments produce growth opportunities, meaning that the growth wedge between the US and other large economies is likely to shrink as we look forward relative to, the past decade and a half.
Can you explain the Draghi report? Because probably some listeners won't be familiar with what that is.
Sure. So the European market, the European Union is intended to operate as a common market. But today there are de facto 27 different markets under one umbrella, which means that there are lots of internal barriers to products moving across jurisdictions, services moving across jurisdictions. These are non-tariff and even tariff-like barriers that the EU can, and the Draghi report argues. Draghi was the former governor of the European Central Bank, and so he's a very, very well-respected and highly competent economist and market leader and participant with many, many years of experience. And so in his report, which was released in September of last year, so about an annual first year anniversary, he has laid out a series of actions that he and his colleagues believes are necessary to counteract the challenges that are posed by U.S. tariffs and to bring Europe out of its doldrums in terms of economic growth and to release a lot more competitiveness and productivity forces such that EU can grow again. And so one of the things that it's talking about, and he's been quite passionate about, is removing internal tariff-like barriers to a proper single market. And this isn't an EU-specific problem. Canada is addressing something very similar. So Canadian economy for many decades now has been more focused on north-south trade, right? Because its southern neighbor, the U.S., is many times larger. And so it's been a very fruitful activity for a lot of the companies and industries. And such that the cross-Canada trade has been very much more restricted by internal provincial barriers. And so one of the focuses of the current administration is to remove those barriers so intra-Canadian trade can prosper to a higher degree than it has been in the recent past. So we are seeing a concerted response in any number of jurisdictions to, like I said, what are de facto America First policies. And that response will show up in better growth and hopefully better returns for investors.
How do you think about like the dominance of US in the technology space? Do you think that's something that'll change over time? I mean, we know a lot of the big, huge technology companies have been in the US. Do you think over time we're going to see more of those coming from abroad and maybe a narrowing of that?
It's too early to say. It's not, you don't produce a, trillion-dollar company just with technological innovation. There are legal frameworks that are in place, all sorts of other protectionist measures. The massive competition that we're seeing between the US and China is very much rooted in the technology space, right? It's not just about AI. It's also about in the warfare. It's also about in physical infrastructure. So robots, electric vehicles, autonomous driving, any number, like I said, even biopharma and healthcare, and increasingly the quality and the quantity of the molecules that China is producing is highly proprietary and is increasingly sought by Western large pharma companies. So the competition is heating up. Right now, it's firmly U.S.-China, but we'll see if, and there are pockets where other companies and players participate meaningfully. Let's see if that broadens out over the next couple of years or a decade or so. Remains to be seen.
Are you optimistic that Europe can also become like a big player in the technology space?
There are some signs that at last Europe is taking this seriously, the fact that they haven't been and that they've lost out. They've certainly not participated in the ramifications of the 4G rollout, and they're keen to make sure that when 5G is rolled out more meaningfully, that their companies are positioned to compete and grow. We're seeing a lot of effort in France, increasingly in Germany, in large parts of the Nordics. But, some of these companies are not as large yet. In the AI space, we're seeing a couple of exciting newcomers. There are, ever larger numbers of unicorns coming out of Europe, but, too early to tell. So I'll reserve my optimism for now.
Olga, I know you can speak to this, but one of the projects I'm involved in is looking at maybe launching a ETF over in Europe. And what's interesting is how different these countries sort of work and operate. Like, you might list in the UK, but like getting distribution in Germany is completely different than it is like Switzerland or something. And so it kind of has opened my eyes to like, yes, there's the euro and, UK is not part of that European Union. But anyways, it's just very like, it's still like country by country. And you can see how those things might stifle like innovation. Like the ETF white labeling business, which is, they've been doing that here in the US for like 10 years, these white labelers. Like over in Europe, it's like a new thing. They're just getting started. I don't know, it's opened my eyes to that, this fragmentation on a sort of country by country level.
You're absolutely right. And this is one of the reasons, I think it was the IMF that estimated that intra-EU barriers, especially in places like financial services, et cetera, are equivalent to something like 150% rate of tariff. I mean, can you imagine if Europe actually got together and built a single market for financial services products? I mean, that would release enormous amounts of capital because obviously Europe is pretty wealthy, and to be able to deploy that capital at scale and to have one regulator rather than 27, would be really powerful.
How do you think about how all this impacts markets? I'm an investment advisor in my day job, and I've been telling my clients for a decade, probably, you got to have your international exposure. You got to have your international exposure in the US. And it just as I've obviously been wrong every single year. And it seems like finally this year, things might be turning. But how do you think about the implications of this for the US market versus international?
Well, that's the exceptionalism part that I think might be coming to an end. So look, you're totally right. For a decade prior to this year, right, investors could just allocate to the US and forget about every other jurisdiction. Over that time period, if I'm not mistaken, US equities delivered returns that are something like 3 to 4 times higher than everywhere else. This has already changed this year, and I think it's just the beginning of a longer-term trend for all the reasons that we've already talked about. But specifically, that growth wedge between US and everyone else is shrinking outright. And so the plurality of relative opportunities that it's throwing up is vast. And this is in developed markets, in emerging markets. Emerging markets are fully participating in this year. And so investors, by all means, should start to look for opportunities outside of the US.
I know you know this as well, but the challenge of this is always like when something's not working for a decade, you can talk to clients about 100-year periods all you want. Like they don't want to hear about it. If it hasn't worked for a decade, it's like, I don't want to be doing this anymore.
Exactly. But the minute it changes, people will notice. So this year's first. And also, under the hood, I tell, whenever I say this, people are shocked. But, some of the economies in Europe have been roaring. In fact, it's places like Spain, Italy, Greece are some of the best performing economies and markets globally. And it's not just this year, but for several years running now. Their returns have rivaled anything that we've, seen here in the US. So there's a ton of churn and opportunity under the hood. And I think a lot of that will become more obvious as this decade rolls on.
Do you have any thoughts on comparing like the late 90s tech bubble to what we're in today? Obviously, for someone like me who likes value stocks, who likes international stocks, like I hope it's the same. But by the same token, I have to be honest and say, Cisco traded a much bigger multiple than these companies do. So these seem to be better companies that are trading at more reasonable valuations than back then. So do you have any thoughts on comparing and contrasting the two periods?
Sure. So look, because of where I sit professionally, my first area of comparison is economics. So look, I mean, interest rates were broadly at similar levels that they are today. Right? Economic growth was pretty widely dispersed. We didn't talk about US market exceptionalism quite as much then. We had just come off a period of rapid internet connectivity build out, to your point on Cisco. But the next wave of market leaders, those who put the new technologies to use, hasn't hadn't fully emerged, by that point. And that's exactly kind of the air pocket that we're in right now, right? So the technology builders, the AI builders, if you will, the LLM model developers, the data centers, all the attendant connectivity that is necessary there, the tech, hardware, all the infrastructure, all of these are leaders today. But the next generation of leaders, right, that are going to take this technology and apply it to their area of expertise and release vast amounts of new products, services, completely change how we live in many cases, has yet to show up. So it's that next wave of innovators, the AI adopters, as I call them, but there's probably a fancier word for it, is yet to become obvious. I mean, just think of a company that is going to crack, the cancer code, right? But this could be, a current biopharma company, it could be a tech company, or it could be a company that hasn't even been founded yet. We just don't know.
That's the challenge of this whole thing, right? Is when people look back at the Amazons and the Googles of the world, they want to invest in those companies for the AI age. The problem is, it's very, very hard as we sit here today to figure out who they're going to be.
Exactly. Well, and this is why growth and investing are such dynamic experiences and endeavors. It really requires, full-time, professional, highly dynamic lens on what is happening, who is being disrupted, which we can sometimes see earlier, and who is the disruptor, right? That's the exciting part.
Thinking about this idea of the big tech players, one of the things I think about a lot recently is this idea of concentration. The U.S. market is about as concentrated as it's ever been right now with these big tech names. And I think about, is that a risk to the market? I just think about that on a lot of different levels. Do you have any thoughts on that?
Sure. Look, I think the U.S. market concentration reflects in part, the monopolization, if you will, of the U.S. economy. So in the 1980s, we've reinterpreted antitrust laws and regulations to allow for ever greater consolidation. And concentration is one outcome. I think the OECD estimated that something like, 70 out of 130 industries are now, classified as monopolies or oligopolies. Now, don't ask me to name 130 industries. I would probably struggle to name 20. But that market concentration is evident for many to see. And so I think, the U.S. equity market concentration is really a feature. It's not a bug of our current system. So is it a risk? To an extent, but that's the system we've built. So that's how I think about it.
I know you're a growth investor, so I might know your answer to this, but this is something I think about a lot, which is this idea of, because we're in a world dominated by technology, because of the growth and, because growth is benefiting these large companies, we've had this situation where value stocks, small stocks have just struggled for an exceptionally long period of time. And people like me who look at the data can say, well, that's an opportunity. It was an opportunity in 2000. But then I could also take the other side of it and say, a lot of these trends, this growth machine is benefiting these bigger companies. And maybe, being a value investor is not the greatest thing in that world. So do you have any thoughts on that idea in general?
Well, like you said, so I approach this firmly from a growth mindset and from the perpetual growth machine as directly relevant. And so, look, where do you see market leading or market inflecting, or what the market is rewarding, is somebody whose profit is inflecting up, right? And that usually happens on the back of revenue growth or some new generation or entering into a new market. So it's all about relative growth. There's no value without. Now, we can debate whether that growth needs to be 100% per annum, which almost no one ever achieves, certainly for not any length of time, or it's an inflection from 3% to 5% or from 1% to 5%. But the point is, it needs to be a positive inflection in growth that, investors think can be sustained for a reasonable period of time. And without that, you can't really see a meaningful reacceleration in profit growth. And so that's what leads ultimately to market leadership. Almost any company you look at on almost any time horizon, the vast majority of its returns is derived from earnings growth and dividend to an extent, right? And that of course isn't true on shorter time horizons or in different parts of the economic cycle, but over longer periods of time that seems to hold. And so you're always looking for relative growth opportunities. Where will the economic structure change to incentivize more competition, smaller players coming in, disrupting more, to your point, stocks that have been left for dead, that have become value stocks because they are so cheap. But are they cheap because there is no growth and are growth prospects inflecting? then they're really interesting. Or are they cheap because there is no growth and it doesn't look like they will have growth? Well, then they're less interesting.
Yeah, what you said reminded me of a quote from Michael Mauboussin when he was on the podcast. He said, value investing is buying something for less than it's worth, full stop, I think is exactly what he said. And then that gets to that whole idea. Like a lot of people just buying cheap multiples are not thinking about the other part of that equation, which is if the company grows. I mean, Amazon back in the day was a huge value stock, even though it didn't look cheap on any of those metrics.
Exactly. In hindsight, growth makes everything look cheap. It's finding that growth and appreciating it ex ante that is so devilishly difficult.
Just one more for me before I hand it back to Justin. I wanted to ask you about rising public debt across the world, because this is something we talk about a lot in the podcast. It's people, a lot of people are very, very concerned about it. Some people think it'll lead to higher inflation. I'm just wondering if you could help us put that in context. Like, how do you think about this issue of rising public debt across the world and how it impacts all of us?
Jack, honestly, my honest answer here is that nobody really knows. But here's what I do know. The U.S. enjoys what one finance minister famously described as an exorbitant privilege. What that means in practice is that we issue the currency in which our debt is denominated. So the same constraints that most other economies, and especially emerging markets economies, frankly, do not apply to the U.S. So that's the good news. The other side of that is that much of our current deficit is going to service interest payments, and that's not a very productive use of capital. So at some point, this becomes a binding constraint, which is one of the reasons the administration is pursuing any methods to lower interest payment and the burden of those. But the preoccupation on debt is usually it's a one-sided argument. I think the broader question should be, why are we not growing faster? How can we spend and invest in such a way that will unleash more growth for broader parts of the economy, broader parts of the consumer, broader parts of the employment ladder, et cetera? And I think, growth is a magical balm, elixir, that can lessen those debt burdens and make those debts a lot more sustainable and a lot smaller over time.
Jack had mentioned Michael Mauboussin, and then you mentioned companies growing at 100% and being able to maintain that. And I'm just curious, like in your own process, and the reason I'm tying those two things together is because he looks at like earnings growth across U.S. companies historically and shows that, companies growing earnings at like 30% a year over 20 years, there's almost like none. Or maybe there's like, less than 1% or 1/10 of a percent or something like that. So, and he uses it as an example of like base rates and using probabilities when looking at things like this. So I'm just genuinely curious. So, do you incorporate like base rate and probability type of sort of frameworks into the way that you look at markets and economies?
So I don't use base rates explicitly. Our internal research has very much corroborated that same point. If you look at the number of companies that are actually able to, across almost any jurisdiction and almost any time period, that are able to sustain even 5% growth rates for more than 3 years, it's something like 25% of the companies. When you go further out the horizon, again, and 5% nominal growth, you would consider a pretty pedestrian, growth rate. Go out to 5, 7, 10, 15 years, and there are very, very few companies. Now, it's obviously exciting to have really, really strong growth rates, but the truth is only a handful of companies are able to generate, and even fewer companies can sustain those growth rates for anything more than a couple of years. So the point is that growth is really, really dynamic and really fleeting. It's really difficult to be at the top. There's a constant churn at the top. And that paves the way to that's very consistent, again, not to go back to the perpetual growth machine, but here it is again. Growth is highly dynamic, and there's a tremendous amount of churn at the top.
How do your PMs sort of take what you do on the strategist side, and what's the marriage like internally, like in the investment process? Is it like digesting the research that you're putting out, looking at where you think the trends are going, and then trying to marry that with like bottoms up fundamental stock selection and investment analysis? Or like explain that process. I'm really curious actually how that works.
That can work on several levels. First of all, it's not just PMs. A lot of the sector analysts and company analysts are very focused on this, right? So one of the principal takeaways here is that in doing fundamental research and in making an opinion or formulating an opinion on a company or an investment, don't just look at one or two stakeholders. Look at all of them as broadly as possible. So there are six types of stakeholders, anybody from regulator to employees to management to suppliers, competitors are can be hugely insightful as to what are the needs, what are the challenges a particular business is facing, what are they doing to innovate? Is their business strategy aligned with their strategic objectives? Can they deliver culturally on what they're seeking to do? What kind of grower are they, right? So these are all the questions that are relevant and that are part of our increasingly part of our investment process. And then there are the sort of broader macroeconomic questions. So what governments are undertaking reforms to unblock growth challenges? Where is growth likely to inflect up? The flip side is also true. What governments are actively undermining their future growth prospects or country's growth prospects such that we may want to get out of the way. So, all of these are relevant for both analysts and portfolios.
Just going back to sort of this idea and looking at growth, you've talked about finding growth or looking at growth opportunities through like firsthand observation. So is that like the Peter Lynch, like buy what you know type of idea? Is that what that is? Is that what you're getting at there?
And only partly. Look, I'll be a little bit of a typical economist here and use both hands, right? So on the one hand, bad news tends to dominate the headlines, and financial media doesn't seem to be an exception to that. So both professional investors and general market participants are constantly bombarded with what feels like bad news, and bad things are here and there and everywhere. But on the other hand, this is my other hand, markets continue to scale new highs. So how do you reconcile those sometimes? And how do you reconcile that for, jurisdictions that are further afield? So I found that if I don't pay attention to where things are improving or deteriorating, it's really difficult to make sense of market movement.
Right. So it's like the getting under the hood thing, like actually looking at the data, finding your own, not, listening to consensus or looking at the media, but finding looking at independent data and drawing your own conclusion in your case.
Exactly. I'm a big fan of that.
Yeah, that's great. Okay. Where do you see, where is the biggest risk in today's market or economy, and where is the biggest opportunity in your opinion?
Well, the biggest opportunity, I think we've already highlighted, it's ex-US. So the US market has enjoyed tremendous dominance over the last decade and a half or so. And I think the biggest opportunity on a go-forward basis lie outside of the US, whether it's Japan, Korea, Europe, some of the smaller DM economies, select emerging markets. One of the areas that is very troubled geopolitically, but paradoxically is undergoing tremendous changes, which is one of the reasons it's troubled geopolitically, is the Middle East. Never thought that we would be discussing, opportunities in Saudi Arabia, in investment cases for Saudi Arabian companies and IPOs in my professional lifetime, but we increasingly are, and these are really exciting opportunities. They're doing a lot to unlock their growth and to really change the way their societies work and function. So those are all areas of opportunity. In terms of risk, look, this U.S. retrenchment from the global world order and the U.S.-China, what feels like an increasingly adversarial relationship, has the potential to undermine the longest period of peace and economic prosperity in modern history. And that is a huge left tail risk. Let's hope that the probability of it is really, really tiny and it never materializes. But post World War II idea that national economies might be so tightly bound by trade and production, et cetera, that starting a war will be virtually impossible or unprofitable was a good one. It generated a very long period of peace, which brings obviously enormous economic growth, prosperity, and not least investment return. That idea underpins, the creation of the European Community and later the European Union, and it's really revolutionary in the social sense. And we somehow, I think, must find a way back to an international world order based on that mutual interdependence. Because building up national militaries, which is kind of what we're seeing today, while might be very profitable in the short term, feels really dangerous to me.
So we have two standard closing questions we like to ask all our guests, and you can go anywhere you want with these. The first is, what's one thing you believe about investing that most of your peers would disagree with you with?
Justin, I'm not sure. The truth is, I rarely pay attention to what my peers are doing. Because, quite honestly, understanding what is actually happening in markets, in the world economy, in different industries, keeps me plenty busy as it is. So, not sure I have a good answer to that question.
Okay, that's fine. That's fair. You're just.
I think you gave the answer, which is you rarely pay attention to what your peers are doing, and everybody else actually does pay attention to what their peers are doing. So yeah, I think inside that answer was the answer.
And the last one is, based on your experience in the markets, what's the one lesson you'd want to teach your average investor?
Well, I think I'm certainly humble enough to know that I know very little. But I would say, stay curious, stay nimble, question common narratives. In other words, pay attention to facts, because I think facts change faster than perception.
Great. Thank you very much, Olga. We've enjoyed the conversation with you today.
Thank you, guys.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.